Let's take the discussion on market forward with Rahul Singh also joining us now from Tata Mutual Fund. Rahul, good afternoon. Thank you very much for your time. How are you analyzing the large cap universe valuations right now with the talk of recovery which lies ahead, commentary and data points on earnings which is pouring in versus the recovery in the stock prices we've already seen from March lows?
And good afternoon. I think one has to basically fall back on earnings and see how the Nifty 50 earnings have behaved. And interestingly, if you look at the data of Nifty 50 earnings on an aggregate basis, we saw that there was a sharp cut in earnings till about end of June. And post end of June, we've actually seen the Nifty 50 EPS being pretty steady, not only for this year, but for the estimates for the next year, which is fiscal 22. I think that's the starting point. I mean, end of the day, recovery data points we are getting now, the macro data points. But if you look at in July, August, September, 3 full months, we did not see any further earning cuts, despite the fact that the lockdown actually, or the let's say the activity was impacted much longer than what anyone thought. Sitting in June, nobody thought that sitting in October we would still be in a unlock phase. So I think that's the starting point, and that has been a positive surprise. And there are 2-3 reasons for that. I think the companies have managed to cut costs better. A lot of companies are saying that a lot of the cost cuts will, maybe 40-50% of the cost cuts will stay. And the remaining will come back. Similarly, we've seen surprises in IT and pharma and some of the other sectors, chemicals and so on. And lastly, I think where there is a lot of negative expectation still, which is on the banks, we are seeing initial data points as not as negative as what I think the market is fearing. So if you look at the package as a whole, we could be in a situation where the fiscal year 22 EPS estimates will not undergo any further downgrades. And if all goes well, and if actually the banks are right, then we might actually see a little bit of an earning upgrade.
Aditya and Mitul Shah is also joining us. Rahul Singh is with us. Rahul, just a word on the two-wheeler space. You've been looking at it closely. The way two-wheeler turned out to be a rural play, some of them who have better exports, yes, as my colleague was saying, all of them have taken into better efficiencies and margins are looking higher. How do you look at this entire two-wheeler space?
Yes, I think the companies which are positioned towards entry-level two-wheelers and also have higher exposure or higher demand contribution coming from rural areas are the obvious ones. Some of that re-rating has actually already happened, and we have seen an inventory build-up leading up to the festival season. Let's see what happens post the festival season, because what we are not sure right now is how much of this is pent-up demand and whether the actual demand will follow through after the festival season is done with. So we are a little cautious on the two-wheeler segment as compared to, let's say, the passenger vehicles or tractors. But having said that, I think the valuation, what is, I think, good about the space is that the valuations are still somewhat reasonable with good support from balance sheet and capital return policies and dividend yields, etc. So I think that will mean that the interest will remain alive, especially given that we have the valuation comfort. But from a growth perspective, I think there are question marks at this stage to be committing additional, weightage to these stocks at this point of time is not an easy decision.
Right. Just hang on, Rahul. We need to just cover this a bit more and come back to you on markets. Aditya, what did you make of the numbers and what's your call on the stock now?
Sure. Look, the numbers were fairly good. They did, margins of about 17.5%. The volumes have crossed 1 million units in this quarter. I think the third quarter will again be fairly good, because of festive season, as a prior participant just mentioned. But even on the export side and three-wheelers, we are seeing that, volumes are incrementally bottoming out, and in fact, they're picking up. So if you look at the Unlock 5, which is happening across the large metros, various large centers are now opening up, where we believe the three-wheeler demand can now actually, start coming back. And that is a significant margin driver for the company. On the export side, we are hopeful that, volume should start picking up. It was already visible in September. So I think net-net, Bajaj, will want to bank on, even non-two-wheelers going ahead. Of course, two-wheelers are seeing a pickup. The Pulsar has done extremely well. Our call is, we have an ad rating on the stock. And one should accumulate the stock if you have a longer-term horizon of about 3 to 5 years. Given the premium initiatives the company is expected to roll out from 2022, be the Triumph or JV, which is expected to hit the roads. So the company on the premium side is doing a lot of things. And as the economy normalizes over the next 12 to 18 months, these segments will then start seeing the pickup. So, we are positive at this point, but from a medium-term perspective. Thanks.
Mitul, what about you? What would you want to hear from the management at this level with this kind of a performance and a stock? And also, how do you compare it with its peer, Hero Motor?
Certainly, performance is very strong. EBITDA margin of 17.7%, which is a very high in the last 2.5 years, though it is below 20%. But in this situation, where during the quarter, overall three-wheeler contribution, which is a very high margin segment, was much lower compared to normal quarters. And secondly, export contribution in terms of volume was slightly lower YOY. Despite that, company reported sequential as well as YOY EBITDA margin improvement is definitely commendable. Certainly, product mix in an export market was better with higher Pulsars. And Latin America, sales of the Pulsar was quite high. Domestic market also, premium segment is improving. And most important is cost control. Company has done a lot of cost control on the advertisement as well as travels and all those expenses. So these margins is indication of good performance. However, going forward, near-term challenges that post-festival, there is a question mark on the sustenance of the two-wheeler demand in domestic market as well as export currency slowly becoming adverse compared to the pre-peak level. So this factor may put some pressure on the margins going forward. So we would like to watch from the management guidance on the margins and export commentary for coming quarters. On the positive side, most important, as you said, that compared to other peers, company's cash and cash equivalent is a very strong. This at the end of quarter, company reported 16,240 crore of cash and cash equivalent, which is a big positive in this situation of pandemic where most of the people are facing cash crunches, and this would help supporting the dealership network and entire value chain system for the company. So it's a key positive for this company compared to the peers within two-wheeler.
Okay, so Bajaj Auto, which went down 2-3%, has recovered everything. It's got a good reaction. Mitul and Aditya, thank you for joining us. Rahul, stay with us. Rahul, quick word on how are you really playing some of the large index components, which the weight of which is just keeps on going higher. Now, no longer just oil and gas, but also getting a big technology flavor. What are your thoughts on the way business model is evolving, not the stock performance?
No, obviously, I think the big companies have become stronger, and given the balance sheet and the funding constraints, the opportunity for big companies to really become stronger is there today in general. I'm talking about not only in India, but across the world. And we are seeing that for example, the big tech companies have also become stronger, and also there has been consolidation in the retail space in India, in telecom, in e-commerce. So there is obviously a lot happening. And to some extent, I think that is a function of the mistakes or the over-leveraged balance sheets of some of their competitors. And on the other hand, I think there is a benefit of ecosystem today, which is there when you have a digital kind of presence, how you tie in different stacks of that ecosystem and make your presence felt across the ecosystem. I think that opportunity is there, and we are seeing IT companies, telecom companies do that in India, and I think that will continue. And my own sense is banks are also trying to do it. So if you see the larger banks using their digital presence, they are trying to control greater and greater share of the consumer's wallet. Not only on the spending side, but on the loans, on the credit cards, etc. So we are seeing between banks, telecom companies, and IT companies really a wave to dominate this digital ecosystem, which frankly after COVID has got accelerated by at least 18 to 24 months by various estimates of the analysts. The adoption of digital as a mode to mode to transact, I think that has got preponed significantly by 18 to 24 months. So it's a function of a lot of developments, including COVID. It is not really just a function of large companies' strategy or them trying to dominate or exercise their influence. I think it's a confluence of a lot of factors.
Right. All right, Rahul, we'll let you go on that one. Thanks so much for joining us on the show. Time for a very short break. On the other side of the break, we'll get you some more news and analysis, so don't go anywhere.